Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
We've never seen a period if you go beyond 2002 and move back, these correlations break down in a very big way. We never really used to be able to trade currencies on these pure correlations because the world wasn't so credit driven. That whole area, and Greenspan and company from 2002 on got busy and created all these derivatives, and all this credit really just was forced out. These correlations started to be dead on, and now they're very, very tight. So we have to assume they're not going to change. We saw it today, fall in the S&P 500, and then the let me just pull this over here a second. Let me grab my. The Dow was ended down 93. And the U.S. dollar was up pretty strong. The euro got hit. The euro mirror image of the dollar got hit today pretty hard. Stocks down, euro down, commodities down, dollar up. So it's in play. The commodity currencies got hit a little bit today also. So these correlations are very, very tight. So this is how you can see the dollar as the funding currency. If these correlations start to change, then you have to be wary about your idea of the funding currency to a degree. The other scenarios, from the fundamentals, and again, I say you can't develop these scenarios purely from the technical analysis, and that's why I think this is important to look at. Even if you're a tech player, I think you can continue to use your technicals, and we use a lot of it, and we think it's good, but we always like to have a market view when we do something. The other view is the dollar bounces on the stock market correction. We're already seeing that today, as I said. In a pretty big way, very, very quickly. The correlation between the dollar and the S&P 500 is incredibly tight. The last measure we did was about 2 weeks ago, and it went from a 90% correlation on a 30-day period to a 92% correlation It went from on a 90-day period, it went from a 90% correlation down to, and when you looked at the 30-day period, it went to a 92% correlation, negative correlation, meaning the stock market up, dollar down. That's incredibly tight. That's almost tick for tick. That's why you hear currency traders saying, what's the stock market doing? And you hear stock traders saying, what's the dollar doing? It's really getting kind of odd here, given the correlations are so tight. So if the stock market corrects, makes some type of just technical correction, we would expect the dollar to bounce, and that's what we've seen today. But if it is just a technical correction driven by some overbought in the stock market, we would expect things to go back to normal if there's no change in policy or no perceived change in the fundamentals or change in the global macro fundamentals that we can see. Right now, we happen to think the real economy, as we said, the real economy isn't really getting any juice. Consumer credit's declining. Balance sheet cash is rising tremendously on corporate balance sheets. It's the highest, I think, on record. We're not seeing the opportunities in the real economy for investment. So this money is just being sucked off into the financial markets. Think of the world as a real economy, financial economy. The financial economy is getting all the juice, which suggests to us that the financial markets are detached from the real economy in a pretty big way. So a correction makes some sense and maybe brings those back into play. So that's one of the reasons we've been leery in this market in here. We think the detachment's getting wide. It doesn't mean the market can't continue to go higher after a correction. It sure can, and it may not correct. One day sure doesn't make a trend. Though part of the problem with this view that we may even see a stock market correction is that there's a bunch of people that are still bearish out there. The newsletter world is almost 100% bearish. That in itself should be a red flag to bears that this market could run a little further. I happen to be in the same camp, unfortunately. It's very uncomfortable. But if we do see a correction, the dollar should bounce given those correlations we just showed you. But if there's no real underlying change, we're just looking for a trade. We're looking for something short term. And what we would be trading, we'd be shorting or buying puts on the euro, the thing that we liked, and also the commodity dollars, those things that have run up the most. In the spot market, we happen to be short the New Zealand dollar today because it's run up in a big way. So if we see a correction, we would expect it to fall pretty quickly, pretty fast. And again, we're just looking for a correction in here until we see something else. But from an option standpoint, if we're looking for this type of trades and we're only thinking correction, then we want to stay short. You want to stay short with this trade, maybe buy a 1-month option or a 2-month option, something like that, so you don't pay for your time premium. And as I said, the targets would be the opposite of the ones that we really loved on the upside that have moved the most, which are the commodity dollars and the euro. So they would be the targets to play on a correction move. The risk bid scenario. This is our third scenario, and this is a major risk scenario. This isn't just a correction scenario, and this is our third most. This is number 3 in our scenarios. 1 is the continuation of the trend. 2 is, as we saw, a correction. By the way, we saw some buying out of Asia last night in the dollar, and that may be part of this move. But our third scenario is this idea of a major risk coming back into play. And it is a plausible scenario. And again, you don't want to create scenarios where there's absolutely no plausibility, there's no use in that. But this one there is, but it's still number 3 in our book. But as we watch the fundamentals play out, if we don't see a return in consumer demand, if the U.S. employment market all of a sudden lurches worse instead of getting a slight bit better, those type of things say, hey, push up this risk bid scenario maybe from a lot higher on the probability scale. And that's the way you have to think about these things in terms of your fundamentals. But our major risk bid scenario is really a lot of things are the trigger for the major risk scenario. And just make this point, whenever we see major global risk in the world, money tends to move back into the deepest capital markets to hide. And there's where the world reserve currency has an advantage in major risk when you see it. Because when there's major risk in the world, these major players have to hide. They come back into the U.S. bond market, and they have to buy the dollar to do that. So the dollar tends to be supported and gets a bounce in a risky world, and why you saw such a big bounce during the credit crunch. So our scenario, so our plays are we could see a double-dip recession, as I just said, in the U.S. or one of the major economies. China could disappoint. China's blowing and going, and everybody thinks they're back in play, and they're going to keep the music playing. Anything could happen there. We don't know. I mean, there could be social unrest at any point. We could see a bubble pop in the real estate market and the stock market at the same time, and money start to flow out. All those types of things if China disappoints. At the moment, China doesn't look like it's going to disappoint. The numbers coming in from China still look good, and the government has said, yeah, we've overjuiced the economy. We're going to have bad loan problems down the road, but we have $2.3 trillion in reserves, and we're going to do everything to keep growth alive, even though global demand isn't out there. So although this is in play, at the moment we have to think China will keep things going. Emerging market crisis. Something as simple as Latvia, a very small country in Eastern Europe, could devalue. If they do, the rest of the Baltics may start, fall into play. Hungary may. And emerging markets are interesting. You get this contagion problem in emerging markets in a very big way that you don't get in major markets because they're fragile. Their financial systems are very fragile. They're dependent on external capital. So when you see one problem in one emerging market, the reason you get contagion is lenders in other emerging markets say, uh-oh, it could happen here, and then they tend to pull back. So it self-reinforces this problem that, so if they didn't panic, you wouldn't see this contagion, but you tend to see contagion because emerging markets tend to move together. If that were the case, it would spread into Europe proper in the Eurozone, and it would be a major global risk bid scenario, type of scenario that would help the dollar, because you'd see capitulation out of emerging markets. Money would start to come out of China, because China is really an emerging market when you think of it in terms of size from the financial market standpoint, and European banking risk. And those are our key major risk bid scenarios that could come into play. But as I said, they're number 3 at the moment.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.